Hi guys, welcome to the Savvy Money Show. Me, your host Sean. Today we're talking about some stocks which, in my opinion, meet a couple of requirements, and it is just my opinion. And I am just an idiot on the internet, so you should do your own due diligence. But they all follow a similar pattern. What is this pattern? They all IPO'd in 2020. They all hit highs in between September. You can tell my writing's well on key, can't you? September 2020 to February 2021. And we're going to look at why I think they've come down and they are going to soar. And we're going to look at another example why they haven't already. They all have a cult following behind them. Now, if we look at if we look at a company which has gone up the last couple of days, I spoke about a couple of weeks ago, GlaxoSmithKline, that's the American one, we want the UK one, yes, and now you'll see there, that bump was because $13 billion worth was put into the market by an investment fund. And what did it raise it? By £1. Now, I get that the market cap of it is a $68 billion company, so it's a bit bigger than the companies we're talking about today. But it shows you the kind of money that you need to put in there. Now, the 13 billion will have taken it to there, around the mid-mark, and then other people getting in as a result of it will have carried it the rest of the way, thinking something was about to be released. Sometimes these funds just put into it because of dividend, or because they think something's coming out, or because J&J's vaccine has been halted. I think GlaxoSmithKline's still working on his vaccine and it's going to come out anytime soon. Anyway, on with the show. The stocks we're talking about are CCIV, Palantir, Tattooed Chef, and Xpeng. Now, with Tattooed Chef, there's been a number of reports from different people, and I'm surprised no one's brought up that their numbers are not quite right. I am super bullish on Tattooed Chef, but they have either overestimated or underestimated the numbers, because the growth hasn't been as great as reported, but at the same time they have been great. Reason why it haven't been as great, because when they transferred from an S core to a C core, that when they transferred between them two, they got a tax break, and that made it look like the growth was bigger than it was. But regardless, they had a great growth. Now, they hit $28, but they now hit under $18. We'll go through a couple of them. Palantir, we saw it hit $38. Now, on the IPO, it actually dipped, like Facebook's. These are companies that are just waiting for Wall Street to get in. And remember the famous saying, if you want to become rich, you get in before Wall Street. Xpen, another one which dipped on IPO, and it's hit over $70. Now it's $31. It could hit $20. But the thing about these are companies that when the market wasn't doing well, these were doing well. Why? Because retail investors were pushing them along. The share structure alone was allowed retail investors to push it up. Now some of them have issued more shares. Or the lockup period has ended, and whatever has happened, it means that it's harder to push it up without Wall Street money. Don't forget to hit that lovely like button, and don't forget the sexy subscribe button. A lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to $200, depending on the platform you use if you deposit a small amount. Wall Street doesn't put in unless it thinks you're going to be guaranteed a return. Look at Palantir. I've heard people saying, and I'm talking about experienced investors, Wall Street investors, say they're not going into it because they don't know how to value it. Because it works with the government, it's a secretive company, they can't value it totally. And I said to them, we'll value it on it's public company contracts. What is making public? No, I don't do things like that. Well, I've gone, well, you do it on that side of the business, and then everything else is gravy that it brings in. And no, we don't operate like that. Okay, but then you'll lose out. By the time you get in, it'll be... But this is the thing. You can't just think, oh, it's going to be a $3, $4, $5 trillion company in 5 years, and think I'll wait for the move and get in, because by the time Wall Street gets in, it will put so much in at one time that it will just happen too quick. Remember what happened with Viacom. That was one company just dumping shares, and look at that move. Went from, you can see that, went from $100 down to 40. It knocked 60% off the value. Same thing can happen when Wall Street goes in. It could increase it by 60%. Now, I've heard the same with Tattooed Chef. Oh, it's just a frozen food company. But it's not. It's a lot more than a frozen food company. And I've heard about Xpeng. It's just another EV company trying to take on Tesla. I heard it with Lucid. It's just another EV company. They're not even producing cars yet. But remember what happened with Fisker? He rushed his car out and it went bankrupt. If you have done your due diligence, these companies, I think, will. These are companies I think will turn around and do well in the long term. You just have to do your due diligence, and you will see. they are not companies you can. They're not companies you can value by the traditional sense, because Palantir, if you look at this, it looks overvalued. Market cap 42 billion against an enterprise value of 40 billion. Forward PE of 110. You know, no price to book. Price to sales 38. You know, so it kind of depends what metric you use. And then when you look at financials, 1.1 billion total liabilities against total cash on hand of 2 billion. So I hope I found a like and subscription if you haven't already. I'll see you in the next video. That's all for now.